Hey guys, what is up? My name is Faz and this video is going to be the entire ICT daily bias guide for you. You can look at it as a full ICT daily bias course. Now, I'm going to teach you all the methods to identify daily bias. Now, there are a lot of methods to identify daily bias, but only some of them work. And I'm going to teach you a couple of mechanical ways, and then I'm also going to teach you a way to find daily bias with discretion, okay? And at the end, I'm going to teach you my most favorite method to identify daily bias. So you have to keep on watching till the end. Now, we're going to start, first of all, we're going to start with the easiest method. And I promise you, this is literally the easiest, and it has a very good accuracy, okay? So it really comes down to these two candles. And first of all, we are on the daily time frame, all right? So before I even begin, we need to understand what even is the point of daily bias, right? We need to find the logic behind identifying daily bias. And honestly, what exactly is daily bias, right? We are trying to predict the expansion of the specific daily candle on that day. So is the price going to push up or push down on that specific day? And to predict that move is called daily bias, right? Now, when we have right daily bias, we can get in the expansion move. So let's imagine, let's say that the next candle, right, is going to go bullish. Well, we can enter at a very sniper level to catch a sniper trade, and we can take big risk reward trades, and also we can avoid unnecessary losses. Okay, so here's the first method. Okay, so on the daily time frame, now this method requires 3 daily candles. Okay, and to predict the daily bias, we only need 2 daily candles to close. All right, so this is the first candle, and then this is the second candle. Now, notice what happened here. The second candle closed below the low of the first candle. Okay, so now I can simply say that my bias for the third day is going to be bearish. And over here, you can see we have the open of the third day. On the third day, we accumulate, and then we manipulate, and then we expand to the downside. Now, if we want to catch this move, what we have to do is after 9:30 open, New York time, we look for a Judas swing, a fake move to the upside, and then we try to take an expansion to the downside. All right. So when your bias is bearish, we look for a Judas swing to the upside, and then we look for a market structure shift, and we take a trade to the downside. Why? Because our bias is bearish. So very simple method. We're using 2 candles to identify our daily bias. So for example, over here, you can see this was the first candle. This is the second candle. The second candle closed just below the low of the first candle. So the next day, the third day, our bias is going to be bearish. We are trying to follow the momentum. We are trying to trade in the direction of the momentum. All right. So on the third day, we're basically looking for accumulation and then manipulation after 9:30 open New York time. We get a Judas swing to the upside, and we take our entry from a fair value gap on the 1-minute time frame, or basically 5-minute time frame. Really depends. But don't worry, I'm going to give you guys examples for each method. So this is going to be a long video, and this is going to be the most detailed video probably I've ever uploaded on YouTube. So make sure you watch till the end. So now this is to identify bearish bias, right? Now, what if the body failed to close below it, and we only wicked? All right, so we only wicked below this low over here. Now, my bias is gonna be bullish because we failed to close below this low. So then we can have our bias that, okay, price is gonna reach this level. Then what we can do is basically we can simply invert this. So what it's gonna look like is that we're gonna have an open. So let's just remove this. We're gonna have an open here, right? We're gonna accumulate, and then we're gonna manipulate after 9:30. We're gonna have a market structure shift, and we can push up like that. Very simple stuff, all right? So if we don't close below the candle's low or high, right, then the bias in this example would be bullish. But if we did manage to close below, then our bias is going to be bearish. And same, it would go for, bullish examples. So for example, let's just say that this candle was bullish, right, and closed above it. So our bias then would be simply bullish, right? So very simple stuff. Now I'm going to give you guys some examples for this method, and then we're going to move on to the next method. All right, now you can see that on the daily time frame, you can see that whenever price closed below this, so for example, let's take this as an example, okay? So this is the first candle, this is the second candle. So the second candle closed below the low of the first candle. Now on the third day, what we had was a wick to the upside, so that was a manipulation move, and then we had a push to the downside. Now you can also see that we closed here, okay? So this was the first candle, this is the second candle. And when we closed below it, you can see that we had a push to the downside. Probably not on the other day, but the day after that. And then you can see that when we failed to close below this low over here, on the third day, we had a push to the upside as well towards this auto block over here, okay? So you can have caught a bullish move to the upside. Now on this, once again, you can see that we failed to close below it, right? So this is the closing point. We failed to close below it. And on the next day, we had a bullish move. So we had a manipulation to the downside, and then we have a push, and we had a push to the upside. Then over here, what you can see is, let's just go here. Okay, nothing happened here. So on the days when nothing happens, right, this candle is closed in between and nothing happened. It didn't even wick above or below it. Then you leave that day. But then you can see that the next day we closed below this low. So the third day was bearish. We had a move to the downside. And then we had another closure here. So the third day was bearish as well. We pushed to the downside. And then over here, what you can see is that we wicked above it. So the third day was bearish, okay? And then over here, in this case, I would say it didn't work out, right? It just didn't work out, right? And that's going to happen, okay? It's just, you're not going to have 100% accuracy, but it's just going to improve your win rate. Then over here, you can also see that we had a wick to the upside, and then we had a push that was a bearish candle. But then here's a great part. You can see that we wicked below it, right? And we closed above. So the third day was bullish, very bullish. Then you can see that we had these bearish days over here, right? And you get the idea, right? This is how you can basically identify. And this is like the easiest method that you can identify your daily bias. So for example, over here, we had a closure above, the day was bullish, right? And then we had a closure above here. The day was kind of bullish, right? And I would say we didn't have a closure above. Okay, so you can see that we had this massive wick to the downside towards this fair value gap. And pretty much, yeah, that's the entire method at method one. Now, what we're going to do is I'm going to move on to the method number 2, and it's going to get better and better. And the last one is my most favorite, so you make sure you keep watching till the end. All right, guys, so here is the method number 2, and this is also one of my most favorites, and it is very easy as well. All right. So what we are looking to do on the daily time frame is we're trying to identify swing lows and swing highs on the daily time frame inside some form of key level. Key levels are not necessary, but they increase your probabilities, all right? So the key level could either be an auto block, could be a breaker block, could be an inverse fair value gap, could be a fair value gap, right? Could be volume imbalance, it doesn't matter. It has to be some form of key level. Could be a significant high or low as well. Now, when we have a swing low formation like this, so we have one candle, second, and the third candle. So this is like 3 candles, right? And 3 candles form a swing low and a swing high. So in this case, what we have is a swing low. Now, what you want to do is you have to mark out the high of the third candle of the swing low. So when we have a swing low formation, right, our bias can be bullish till this high over here, okay? This high, the high of the third candle. So I'm going to repeat this again. Make sure you listen very closely. When there is a swing low, the high of the third candle is going to be your draw on liquidity for the 4th day. So what's going to happen on the 4th day is that we're going to open here, we're going to accumulate some orders, we're going to have a manipulation to the downside, and then we're going to have an expansion to the upside towards this high over here. Now that is method number 2. Extremely easy, guys, extremely mechanical. And when you pair this up with my other strategies that I have on YouTube, I'm not going to give you guys a strategy around this because there are so many strategies on my channel. Just pair those strategies with this daily bias course, and I promise you, you're gonna become a monster. I'm not even kidding here, okay? So yeah, pretty much your draw is going to be this high over here, and we are coming from a key level as well, so that increases the probabilities as well. Now if I invert the chart over here, what you can see is that we have a key level, right, and price forms a swing high over here in this case. So when we have a swing high, our bias is going to be bearish. So when we had a swing low, our bias was bullish. But now, since we have a swing high, our bias is going to be bearish for the fourth day, okay? We are trying to predict the expansion direction for the fourth day. That's all we're doing here, okay? So now our draw on liquidity is going to be the low of the third candle of the swing high. Very simple stuff. So on the fourth day, on the lower time frame, it can be 5-minute or 15-minute time frame. We're gonna have accumulation, right? And after 9:30, or we kind of tap into the standard deviation -2 and -2.5 from this manipulation move low to this manipulation move high, right? And then we get a market structure shift. We take our entry. You can use any entry model. It could be 9:30 a.m., right? It could be the London high and low sweep. It can be anything. There are a bunch of strategies on my YouTube. Go make sure you watch them, right? I'm not gonna teach you entry models in this video because it's gonna become very lengthy. The goal of this video is to teach you the daily bias methods. All right, so very simple stuff. That's how it's gonna look like, guys. Now I'm gonna give you guys some examples on how it will look on the actual chart so you guys can learn more accurately. All right, guys, so here are some examples for method number 2. So let's start from here, okay? We are inside this fair value gap over here, right? And inside that fair value gap, what do we have? We have a swing low. So we have this candle, and this candle. These 3 candles form a swing low, and we are inside a fair value gap. Now what you want to simply do is mark out the high of the third candle of the swing low. So in this case, it is this. Now on the next day, what we had was we opened kind of here, right? And then we had a manipulation for the entire day, and then we pushed up and we took out this high over here. Now after that, what we did, we swept this major high on the daily time frame, and what we did is we formed a swing high. So we have the first candle, the second, and the third candle of the swing high over here, right? This is the highest candle. Now this is our draw on liquidity. So on the lower time frame, we can see that we had a manipulation to the upside, and then we expanded to the downside. Now over here, what you can see is that we have another fair value gap just around this level. And what you can see that inside this fair value gap, we formed a swing high once again. So first candle, the second, and the third candle of the swing high. And basically what you can see is that on the fourth day, we had a manipulation to the upside, power of 3 basically, and then we had expansion to the downside on the fourth day. Literally the easiest methods that I'm teaching you guys right here, guys. Like this is like literally the holy grail of daily bias. And over here, what you can see is that we have like a breakup block, I would say. And over here, you can see that we formed a swing low, right? So we have the first candle, the second, and the third. And on the fourth day, you can see we had a manipulation and then expansion to the upside. Very simple stuff, guys. Literally the most mechanical method I'm teaching you right now. Over here, you can see that we swept the extreme high. I wouldn't say extreme, but like a significant high, and we formed a swing high as well. So the first candle, the second, and the third candle of the swing high. Now we mark out the low of the third candle, and on the fourth day we had a push to the upside, and then we expanded to the downside. Tell me how easy it is, guys. Like I have basically, explained everything about it. I have tried to like not overcomplicate these methods, guys. A lot of people just overcomplicate daily bias, and it's just supposed to be easy. All right, now let's move on to the discretion method. Okay, so it is not a mechanical method, but this is something that I mostly use as well. And if you can master this, then you will not need any of this. Okay, so make sure you watch the next method carefully, and then after that I'm going to teach you 2 more methods, and the final 2 are basically my most favorites, so make sure you keep watching till the end. Alright guys, so here's how you find daily bias with discretion, and this is something that I mostly use. Okay, so it really comes down to 3 points, so you need to know 3 points. Okay, so the first is, what has price done on the daily time frame? So has it swept some form of liquidity? Has it tapped into some form of auto block? Has it tapped into some form of fair value gap? Now again, number 2 point, where is it coming from? Okay, has it swept liquidity? And again, it comes down to these points. All right, is it coming from a fair value gap? Is it coming from an auto block? Is it coming from up or down after sweeping some form of liquidity? That's 2. And 3, where can it go? And basically, price only moves from highs and lows towards key levels. So they could be auto blocks, fair value gaps. So if price is moving in a one direction, you need to know where can it possibly go, all right? So there could be highs and lows, buy side, sell side liquidity, could be a fair value gap, inefficiency, right? Because market seeks inefficiencies and highs and lows, all right? So yeah, that's pretty much how I look at the markets. Okay, so now I'm gonna give you guys some examples on how I look at this, and I promise you're gonna understand like easily, so don't worry. Okay, so basically this is how I identify daily bias with discretion. Okay, so you have to watch very carefully. So very first thing is we need to know what has price done. All right, so basically you can see that we have inversed all of these fair value gaps that are inside this leg over here, right? So let me just drag it along here. Now I was somewhere around here and I actually took trade on the same day with the members, but you can see when we inverse this, right? What I also see here is that we formed this gap, right? And price, when tapped into this, I knew that price was going to go towards these highs over here. All right, so you can see we tapped right into it, right? And then we move towards these highs. Very simple stuff, all right? Then afterwards, what you can see is that we had this fair value gap over here. So where is price coming from, right? And where can it possibly go? And it's gonna go from the fair value gap towards this high over here. So when we tap into this fair value gap, my bias was gonna be bullish. Why? Because we respected this gap, and then we also kind of had a rejection from this fair value gap. So the bias was, all right, we can go towards this high over here. Okay, now I'm gonna give you guys a little tip. So on the next, like the coming week, if we inverse this fair value gap and we close above it, my bias is simply gonna be bullish until this high is taken out. Right, all we really need to know is what has price done in the past, and then we can basically react upon it. Right, so for example, let me give you guys a couple of more examples here. So what you can see over here is that we swept out these equal lows over here. So after price swept out these lows, right, where can price possibly go? It can go towards this inefficiency over here, this fair value gap, because remember, price does only 2 things. It sweeps highs and lows and goes towards key levels. So it can go over here. Now, when price inversed this fair value gap and closed above it, then what would be my draw on liquidity? Simply this high over here, guys. Now look at it here. Did we sweep this high? No, but we swept this high over here. And what you can see is that what is going to be the next level for price to go towards? Very simple, guys. This fair value gap over here. Okay, we move from external to internal. All right, and I'm gonna teach you external and internal method. It's coming up right now, and then at the end I'm going to teach you the final method. So basically that's what I'm looking at. You don't need to overcomplicate. Again, you need to know where the price is coming from, where price can basically go, and what has price done in the past. Has it swept some form of major liquidity? Is there a buy side liquidity untapped? You know, you need to look at it like logically. I hope that makes sense. For example, over here, we swept these equal highs, right? These were resting above here. So then we also kind of inversed. So first, after we swept these equal highs, my first draw would be this fair value gap. Then after this fair value gap got inversed, my draw would simply be this closest liquidity pool over here, this low over here. And you can see how this price kept pushing down, all right? Very simple stuff, guys, very easy. Now let's move on to the next method. All right, guys, so here's the second last method of identifying daily bias, and the final one is my most favorite. So this is external to internal liquidity and internal to external liquidity. So we need to understand that price only does 2 things, all right, collectively. So it either sweeps out the highs and lows and taps into a fair value gap, or it goes from a fair value gap towards highs and lows. And I'm going to explain all of that in a bit, okay? So over here, you can see on the daily time frame, or this could be on the lower time frame as well. It's not really like designed to be on the daily time frame only. So this could be 4 hour, could be 1 hour as well. But let's stick to the daily time frame for now. So let's say that on the daily time frame, we sweep out this high over here. And from this dealing range low to this dealing range high, there is a fair value gap or multiple fair value gaps. All right. So we want to use our Fibonacci and we want to see is there any fair value gap below the 0.5%. So let's say there's a fair value gap over here. That's going to be your first draw on liquidity. But let's say there are no fair value gaps below the 0.5%. There's only one. Then that is going to be your draw on liquidity. Okay. So when we have the sweep on the daily time frame and we have this fair value gap, we have to look for confirmation. Okay. So for this method, time frame alignment is very important. So when we are looking at the daily time frame and we have a sweep of the daily high and we have the daily fair value gap marked out, we want to drop down to 1 hour time frame to look for a market structure shift that is going to confirm the bias towards this fair value gap. So our bias is going to be bearish. All right. So what we have to do is now look for a 1 hour market structure shift, and that's how it's going to look like. Okay. Now when we have a market structure shift, right, on the 1 hour, then we have to take entries, right? So when we have the market structure shift, our bias is confirmed. Now we have to look for entries, and that could either be from a 1 hour fair value gap or could be an auto block. But we can, first of all, we can't enter directly, but we can also look at extra confirmation on the 5-minute time frame. So let's say that now when we have 1 hour market structure shift, we have this fair value gap on the 1 hour. So price taps into this level on the 1 hour, then we can look for a 5-minute market structure shift, and that is going to be our entry, and we can ride it towards this fair value gap, right? So now I'm going to show you another method. So now we did external liquidity to internal liquidity. So external liquidity is basically any high or low, and internal liquidity is any fair value gap. Okay, so let's just remove all of this. Okay, and let's just mark out this fair value gap. Now, if the order flow or the trend is bullish, now what we can do, and this is like easy, and this has high probability. All right, so when price is inside a daily fair value gap, now what is the most logical area for price to go towards? If the order flow, the trend is bullish on the daily time frame, this high over here. So we go from fair value gap to the highs, right? Now when we are inside the daily fair value gap, what we have to do is in order to confirm our bias, we have to look for 1 hour market structure shift, right? And when we get that 1 hour market structure shift, your bias is confirmed. Now we're marking out key levels on the 1 hour time frame, and this is going to be somewhere around here. Now what we do is we wait for price to tap into the 1 hour key level, and then we look for a 5-minute market structure shift. We take our entry and we ride this along. Very simple stuff, very easy, very mechanical. Daily bias, if you can master this, right, and all the methods that I've taught you in this video and I've taught you in this video, you're going to become a monster, in simple words. All right. So let's suppose that this was the 4 hour time frame, right? So we had a sweep of the 4 hour time frame. Now we would look for a market structure shift on the 15-minute time frame, and then we can take our entry on the 1-minute time frame. Okay. So in this case, we tapped into this daily fair value gap, right? We had a market structure shift, and then we waited for price to tap down into the 1 hour fair value gap or a key level, and then we look for another confirmation, right? And we took our entry. Now, if you want to enter directly without going down to the 5-minute time frame, what you can do is when we have a 1 hour market structure shift, you can identify some form of SMT on the 1 hour, and you can look to take your entry directly after change in the state of delivery or a complete market structure shift. Now that we are done with this method, guys, let's move on to the final method, and it is the favorite method of mine. It is the easiest, and yeah, it works really, really well. So let's go on and move on to the final part of this video. All right, so now comes the favorite part of mine to identify daily bias, and it is absolutely mechanical, and it is basically very easy if you watch this carefully. Okay, so now basically you can use this method on any time frame, but if you're looking to identify your daily bias or intraday bias, you can use a daily time frame, and for the intraday bias, you can use the 4 hour time frame. All right, so let's just move everything here, and let's just mark this thing out, right? And this is let's say that's on the daily time frame. All right, Now let's say price has swept some form of liquidity, and watch this carefully. From this dealing range high to this dealing range low, you have to identify all the fair value gaps. So there could be either one, or there could be two or three or four, doesn't matter. Now let's say that there's only one fair value gap here, over here, right? From this dealing range low to this dealing range high. What you want to do is wait for price to inverse that fair value gap. So if price goes up and inverses that fair value gap, then your draw on liquidity is going to be simply this high over that I've marked out. Literally the easiest method, but you have to, in most cases, wait for price to give you a retest of this inverse fair value gap, because on the daily time frame, there's a very high chance that price will come back for a retracement, all right? So when it retraces back into this, that's when you go bullish. That's when you become bullish for the next 2, 3, 4 days until this draw on liquidity is hit. But I promise you, when price inverses a fair value gap, the momentum is going to be crazy, and it's going to go towards that high with a very high volume, all right? Now let's imagine that there was another fair value gap in the same dealing range here. Okay, so you have to wait for all of those fair value gaps to get inversed, and then you're gonna get an entry on the retest. Not the entry, but you're gonna switch your bias to being bullish when we have inversed both of these fair value gaps and we have closed above the last one here, right? And then when price comes back for a retest, as soon as it retests and the new day starts, or it could be the same day, you switch your bias to being bullish until this high is taken out. Now similarly, you would do the same, right? When there's some form, any liquidity, it could be any liquidity when it is swept, right? And you have price inversing fair value gaps. So let's say there was a fair value gap here, right? And price kind of inversed it and tapped into it. You switch being bearish. Pretty much you take short positions, right? Until this draw on liquidity is hit. Now I'm going to give you guys some examples so you guys can understand it correctly. All right, guys, so here are the examples, and for some reason this mic is way too heavy. It keeps pulling my shirt down. But anyways, let's look at these examples, right? So first thing first, what I can see is that we have swept this liquidity, and from this dealing range high to this dealing range low, what do we have? We have two fair value gaps, one over here, right? And also one over here, tiny fair value gap. Okay, so make sure you have your eyes on those. Now when we inversed both of them, you can see that when we had inversed, the next day we came back, retested this inverse fair value gap, and then we had a very clean push to the upside. That was absolutely beautiful. Now one key thing to note is that, let's go over here. Okay, so let me just show you this. So when you have this, right, and you have a fair value gap here, and you're waiting for inversion, if price inverses that, but also takes out the liquidity that we had, right, without giving you an entry of some sort, then that setup is invalid, okay? So you're waiting for another inversion, okay? So that liquidity must stay intact. So that was the first example over here, right? And let me see if I can find a couple of more. So over here, yes, that's the one from the previous method, but you can see we have swap liquidity and we had a fair value gap here from this dealing range low to this dealing range high. We inversed it, we closed below it, but again, we didn't come back to retest it. But again, you know, the drawn liquidity was hit over here. Let me see if we can find some more examples here. Let's just go somewhere around here, and I'm showing you on the daily. Don't worry, I'm going to show you on the 4-hour, and you will see the amount of setups that happen. Okay, the amount of setups that happen are crazy. So over here you can see that we have swept this high over here, and from this dealing range low to this dealing range high, what we have is the singular fair value gap. And you can see when we closed below it, and as I said before, you will not get retest every single time, but then you can see how price moved towards this level over here. That is absolutely crazy on how this algorithm works, right? Let me see if I can find a couple of more examples, and then I'm going to move on to the 4-hour time frame for you guys. So I think this is the low, right? Yeah, this is a low over here. Okay, that is a good setup. That is a good example. So we swept this low over here, and from this dealing range high to this dealing range low, what do we have, guys? We have a fair value gap, right? And price inverses it, and then on the next day we had a retest, power of 3, simple as that, draw, liquidity, hit. Now you can also see that we had this inversion over here, right? And the next high was somewhere around here. So that worked out as well. So you can play things around like that as well. Okay. Now let's see if we can find something else. Oh, that is absolutely beautiful. So we kind of swept, yeah, we kind of swept this low over here, right? And then we have this fair value gap to be inversed. This is the only fair value gap from this dealing range high to this dealing range low. And you can see that was the inversion here, and the drawn liquidity was resting somewhere around here. Let's see if we can find more. Oh, that is another one over here. We swept the high over here. We have this final fair value gap over here in this dealing range, from this dealing range low to this dealing range high. We have multiple, so we wait for the final one. We get a retest, and the draw on liquidity was hit right there, guys. Like, this is so... Can you guys hear the Lambos and stuff going on in the background? Well, thank you for all of these methods. Yeah, that's pretty much, guys. It's going to be the entire video. I promise you this, if you implement all of these methods, you're going to become a monster. Okay, I'm not even kidding here. You can see we had an inversion. Our draw liquidity was still intact, I believe. Yeah, we kind of... Okay, now it was hit right there. You can see the power of this model, guys. This is like absolutely the most mechanical, the most easy method that you can use to identify your bias, guys. You can see over here that we had swept this high, right? And then we inversed this fair value gap over here, and yeah, right there, and we took out this low. Let me go to the 4-hour time frame here to give you guys some examples as well on the 4-hour time frame, right? So you guys can get a better idea. So yeah, so we swept this low over here, and where do we have a fair value gap? From this dealing range high to this dealing range low, I believe this is the final fair value gap. Okay, perfect. And then you can see that was when we inversed it, our drawn liquidity would have been here. Absolutely beautiful, absolutely cinema. That's what we like to see. Let's go here, see if we can find some more setups. Wouldn't call them setups, but like you know, intraday bias. A bit of choppiness going on here, so that's something you want to avoid usually. Over here you can see that we kind of swept this high over here, right? And we had in fair value gap here that got inversed, tap, boom, right there, guys. Like, absolutely beautiful. And then we have another one here. You can see there's a tiny bit of fair value gap that got inversed over here after we swept this liquidity, right? And then we pushed down towards this low over here, right? So let me give you guys one more, and then I'm gonna end the video here. Now, of course, it's not gonna work every single time, guys. You have to understand this, but it has a very high win rate. I wouldn't say win rate, but like strike rate. So over here we have another inversion here, right? Just above it, we close above, we have a retest, and then we take out this level. So absolutely beautiful, guys. I hope you guys enjoyed this course. I hope you guys enjoyed all the methods. Go and test out all the methods and see what works for you. I personally use this and the discretion method, right? But yeah, anything can work out for you differently than mine. So yeah, if you want to trade live with me for absolutely free for 7 days, so you get like a 7-day trial and you see the win rate yourself, there's a link down in the description. Click on it and you will get my course for absolutely free for 7 days, and you will see me live trade in front of you so you can copy my trades. All right, so if you're interested, link is in the bio. Click on it and I'll see you guys inside.